In 48 hours, the market both celebrated and confessed. 28 before the excitement faded into a flat close. In that same stretch, gold didn't fade at all. 60 an ounce, the largest one-day dollar gain on record, 2% in one session. New all-time highs in the benchmark equity index are meant to come with calm confidence. Instead, the so-called safety trade behaved like something had snapped. Not months, not weeks. For years, the story was simple. One engine was pulling the entire train. A tiny group of mega-cap names tied to AI spending and cloud infrastructure became the market's motor. In 2025, just 7 stocks accounted for more than 40% of the S&P 500's roughly 18% total return. The index rose, portfolios rose, and the narrative hardened into something that sounded like physics. These companies are so dominant, so profitable, so essential that leadership can't change. They said this could never happen. They said the rally was self-reinforcing because the biggest companies were the safest, and the safest companies deserved the biggest weights, and the biggest weights deserved the most capital. But markets don't care what deserves what. Markets care about marginal flows, crowded positioning, and the moment certainty turns into a price. And here's the uncomfortable part. Institutions typically feel that turn first, not because they have magic, because they have constraints, they have risk limits, they have rebalancing schedules. They have models that force them to adjust exposure when volatility, correlations, and funding conditions change. By the time the average person hears a clean headline about what caused a move, the positioning has usually been in motion for days or weeks. Welcome to the data ledger, where we decode what matters before it becomes the headline. We take the numbers, the flows, and the market structure, and translate them into the story the market is actually telling. If you like the calm voice that reads the data instead of chasing the noise, consider subscribing. And drop a comment with where you're watching from, because geography is part of the story when capital starts rotating. Now let's zoom in on what actually happened, because the details are the clue. January 2026 was volatile and strange. 4%, which sounds fine until you look at the internals. 3%. Meanwhile, the former leadership started the year uneven. Microsoft was down about 11% in January. 6%, 3%. At the same time, Meta and Google were up around 8%. That is not a clean, unified leadership regime. That's a market trying to broaden while punishing the most crowded parts of the old engine when the results are merely good instead of perfect. Then came January 28th. The Federal Reserve held rates steady. But the better question was why the milestone arrived with a strange kind of tension. When a market is truly confident, protection is cheap. When a market is confident, gold doesn't have its biggest one-day dollar gain on record. 2% in a day like it's trying to front-run a storm. At the exact moment the US benchmark was hanging a banner that said, record high, the market's nervous system was firing. And while most eyes stayed locked on the same 7 tickers, another move was happening in plain sight, outside the usual spotlight. In January 2026, the MSCI Emerging Markets Index rose nearly 11%, adding roughly $1 trillion in market value as the US dollar slid. $1 trillion of market value doesn't appear because millions of small investors suddenly change their minds at the same time. It appears when large allocators shift weight, when currency dynamics loosen the vice, and when relative performance forces a cascade of catch-up trades. So the central mystery is simple to state and hard to ignore. Why is the market celebrating a cap-weighted milestone at 7,000 while simultaneously rewarding broader participation, rewarding emerging markets, and bidding up hard protection? That is what an engine swap looks like. When leadership changes, it rarely announces itself politely. The public wants a clean storyline. Old thing ends, new thing begins. Markets don't work like that. Markets overlap regimes. They mix signals. They force transitions through discomfort, because discomfort is how crowded trades unwind without collapsing the entire system on day one. History has seen this movie more than once. In 1972, the Nifty 50 dominated U.S. equities. A handful of blue-chip growth stocks became regarded as one-decision holdings, names so dominant that valuation supposedly didn't matter. The index looked stable, right up until inflation and rates forced the math to change. The leaders didn't just underperform, they repriced the entire idea that safety could be bought at any price. In 1999, the dot-com era created its own version of that certainty. A narrow set of technology and telecom names drove the headlines, drove the indexes, and drove the behavior. The market didn't first warn investors with a spectacular crash. It warned them with divergence. Breadth weakened. Volatility picked up. Defensives started to behave differently. Then the unwind arrived, and it was fast, because when everyone owns the same winners, the exits are narrow. In 2006 and 2007, the engine was housing and leverage. Financial stocks and credit-sensitive trades were the carry machine. Again, the first signals weren't screaming headlines. They were dislocations. Funding markets tightened while equity charts looked calm. Defensive assets gained a strange bid. Correlations shifted. Then the system discovered where leverage was hiding, and what began as rotation became forced selling. In 2018, after years of mega-cap leadership, the market began to punish concentration. It wasn't mystical, it was arithmetic. A cap-weighted index can look healthy even if the median stock is struggling. When crowding reaches a peak, the marginal buyer becomes scarce and the index becomes fragile. The moment those leaders stop climbing, the whole market suddenly feels heavier. Now in 2026, the playbook is returning, but with a modern amplifier, passive investing and systematic strategies. Cap-weighted products direct the largest flows to the largest names, which makes leadership more extreme on the way up. But the same structure also makes the handoff more dramatic. When the old engine loses torque, it's not just sentiment that changes, it's the flow mechanics themselves. That brings us to institutional movement, because institutions leave footprints. To see the players clearly, it helps to name the machinery. The Fed sets the overnight backdrop, but the day-to-day transmission runs through places most viewers rarely think about. The CME Group's COMEX futures complex, dealer balance sheets, and the ETF creation and redemption pipeline. When gold moves more than $220 in a day, it isn't only speculators clicking buttons. It's also hedgers, market makers, and systematic strategies reacting to price gaps, margin needs, and volatility rules. In stressed moments, authorized participants create or redeem ETF shares, dealers hedge option books, and the ripple hits futures before it hits your feed. $3 trillion in assets are benchmarked to MSCI Emerging Markets indexes, which means a swing in that. Benchmark can force institutional rebalancing. On the US side, the largest cap-weighted funds, core S&P 500 products from issuers like BlackRock, Vanguard, and State Street, automatically funnel new dollars into the biggest names. Equal weight products do the opposite. They compel regular selling of winners and buying of laggards, which mechanically spreads leadership across the index, and they force rebalancing whether anyone feels emotional about it or not. That's why a tilt in flows can look like a sudden change in what works, even when the economic narrative hasn't changed at all. In a rotation, those mechanics matter more than opinions, because they dictate who must buy, who must sell, and when, even if nobody publicly explains the shift. When those two systems run side by side, even a small change in flow direction can reshape leadership faster than most headlines can explain in practice. Start with ETFs. US-listed exchange-traded funds pulled in nearly $60 billion during the week ending Friday, January 16th. Total inflows topped $100 billion just over 2 weeks into 2026. $5 trillion in net new assets in 2025. That's a fire hose, not a trickle. And when a fire hose points in a new direction, the market doesn't need a dramatic headline to move. It just needs steady pressure. But the more revealing footprint is not just how much money came in, it's where the money expressed preference. One of the quiet signals was the popularity of equal weight exposure. 9% year to date by January 19th. Equal weight is a bet against extreme concentration. When allocators tilt toward equal weight, they're not necessarily abandoning the index. They're changing the engine that drives their returns from a small set of giants to a broader set of contributors. At the same time, the AI supply chain was still throwing off eye-watering numbers, which is exactly why this transition is confusing. Between November 2024 and January 2026, the S&P 500 ran from 6,000 towards 7,000 in roughly 302 trading days. Along the way, some of the standout winners were not just the household names, but the infrastructure names. Western Digital climbed about 396%. Micron rose about 278%. Seagate gained about 265%, 6%. That is what a late cycle narrative surge looks like. Not only are the giants big, but the picks and shovels are behaving like lottery tickets. But here's the catch. Booms don't die because the story becomes impossible. They die because the price begins to assume the most perfect version of the story, and perfection has no room to surprise. That's why leadership can stall even while the underlying technology trend continues. The story can remain plausible. The market can still decide the certainty was overpriced. Now we arrive at the dislocation, the place where the market tells two opposite stories at the same time. The S&P 500 at 7,000 is strength. A positive January is strength. Earnings resilience is strength. A strong run from 6,000 to 7,000 in just over a year is strength. 60 is stress. 2% in a day is stress. The former leaders showing mixed to negative returns while smaller companies outperform is stress. Emerging markets adding roughly $1 trillion in value as the dollar slides is not stress by itself. But combined with the metals spike, it looks like global capital seeking optionality and protection at the same time. These stories can't coexist forever. A market can live with dislocation briefly, but it eventually resolves. Either the stress signals fade and the old engine restarts, or the strength signal weakens and the transition becomes obvious. To make this concrete, consider the difference between an index and the experience of the average stock. If 7 stocks delivered more than 40% of the S&P 500's 2025 return, the remaining 493 stocks delivered the majority of the rest, but in a far more uneven way. A cap-weighted chart can rise even if participation is thin, because weight concentrates. When participation starts to broaden, the index can still rise, but the identity of the winners changes. Then consider the difference between price and flow. A price chart is what happened. Flow data is how it happened. When ETF inflows exceed $100 billion in 2 weeks, it implies persistent demand. But when that demand starts to favor equal weight products and broader exposure, it's a vote against crowding, even as it stays in the market. Now add in the metals move. A single-day jump of more than $220 in gold is not just a chart event, it's a funding event, it's a collateral event, it's a volatility event. It can be driven by hedgers, by systematic trend followers, by short covering, by currency expectations, or by a scramble for insurance after a shock. The point is not to guess one cause. The point is that the demand arrived with urgency. Urgency near an equity milestone is often a clue that the market is shifting from a narrative regime to a balance sheet regime. Narratives lift prices. Balance sheets decide who survives volatility. So how is an engine swap executed in a market that still looks healthy from a distance? First, through the simple math of cap weighting. In a cap-weighted index, the biggest names attract the biggest dollar flows. Those flows push prices up, which makes those names even bigger, which attracts even more flows. It's a feedback loop that rewards concentration. When that loop is at full speed, it feels like inevitability. Second, through the behavior of systematic strategies. Volatility targeting funds reduce exposure when volatility rises. Risk parity portfolios rebalance when correlations change. Trend strategies flip when momentum stalls. None of these strategies needs a dramatic headline to act. They respond to the market's own motion. That means leadership can change even when the average investor feels nothing has happened yet, because the actions are spread across thousands of small rule-based adjustments. Third, through rebalancing calendars and benchmarks. Big institutions don't believe in a story the way social media believes in a story. They own what they must own to track a mandate, and they adjust to keep risk and tracking error within limits. When a few names become too large a portion of the index and too large a portion of the portfolio, risk committees push for diversification. Equal weight allocations, sector trims, and international reallocations become the practical way to reduce crowding without making a dramatic all-or-nothing bet. Fourth, through currency dynamics. A sliding dollar changes the payoff structure of global equities, commodities, and debt. It can loosen financial conditions outside the U.S. and make emerging market returns look more attractive in dollar terms. When emerging markets rise nearly 11% in a month, adding roughly $1 trillion in market value, it becomes a self-reinforcing performance signal. Underweight managers feel pressure, overweight managers feel validated. The result is more capital flowing to the new engine. And fifth, through the psychology of milestones. Round numbers like 7,000 attract attention, and attention attracts short-term positioning. Short-term positioning raises sensitivity to surprise. Sensitivity raises volatility. Volatility triggers hedging. Hedging can create strange cross-asset behavior, like metals surging even as stocks hover near highs. Here's the simplest analogy. Picture a city power grid. For years, one huge plant has supplied most of the electricity. Everyone assumes it will always be there because it has always been there. Then demand rises, maintenance gets harder, and suddenly the grid operator starts routing more power from smaller plants in different regions. Lights stay on. From the street, nothing looks different. But inside the control room, the whole map is changing. The power is still there. The source is different. And if the main plant falters, the system either adapts smoothly or it flickers. That is what's happening when a market keeps making new highs while the leadership quietly changes. The lights are on. The source is shifting. So what is replacing the old engine right now? The data points to 3 replacements working together. One is breadth. The move into equal weight exposure and the outperformance of smaller companies in January suggests that the market is trying to distribute leadership. 2 is global rotation. Emerging markets gaining nearly 11% in January, adding roughly $1 trillion in value as the dollar slides, is not a footnote. It's a shift in where marginal performance is coming from. It's also a shift in where risk is being expressed. When capital begins to reach for returns outside the most crowded U.S. megacaps, the market is admitting that the old concentration trade is no longer the only game in town. 3 is protection and real assets. 2% in a session signal that some part of the system is paying for insurance or liquidity. Even if equities remain broadly supported, this kind of metals behavior suggests that the macro backdrop is not as calm as the index headline implies. These replacements aren't clean. They don't arrive with a ribbon cutting. They show up as dislocations, then as performance, then as a new normal. Now, what does this historically lead to? Not a guarantee, a set of tendencies. When leadership broadens, the market often becomes harder to trade but healthier to hold. Returns can come from more sectors, more regions, more company sizes. The index may rise more slowly, but it can become less dependent on a handful of names. And when leadership changes under the surface, while the index stays near highs, volatility often persists. That's because every rally attempt becomes a test. Will the old leaders resume dominance, or will the new leaders keep taking the baton? This creates sharp rotations. Yesterday's winner becomes tomorrow's laggard, then reverses again. It's a market that punishes certainty. And when protection becomes expensive quickly, it's a reminder to watch for hidden leverage. Many transitions remain orderly, some become forced. The difference is usually funding. If a shock reveals that too much leverage was built on the assumption of low volatility and stable correlations, then the transition can accelerate. In that scenario, the index doesn't fall because the economy suddenly changed overnight. It falls because portfolios discover they were more exposed than they thought. So the practical way to watch this, as a matter of observation, is to monitor a few specific indicators. Breadth relative to the index matters. If equal weight keeps outperforming cap weight, leadership is distributing. If the Russell 2000 continues to hold a performance edge, it suggests risk appetite beyond the giants. Cross-asset behavior matters. If gold stays elevated after its record jump and remains bid, even when equities try to rally, it suggests persistent demand for protection or collateral. If silver's strength persists alongside rising volatility, it reinforces the idea that something is changing in macro expectations. Global relative performance matters. Emerging markets relative to the dollar is a classic liquidity signal. If the dollar continues to weaken while emerging markets maintain gains, it suggests financial conditions are supportive globally. If the dollar snaps higher and emerging markets stumble, it can signal a tightening impulse returning. And credit matters quietly. Equities can celebrate milestones while credit spreads widen. When that divergence appears, it often ends with equities catching up to credit, not the other way around. This is where the divide shows up. It's not about intelligence, it's about what gets tracked. Most people track the index and the headline narrative. Institutions track flows, concentration, and the behavior of markets that normally move in harmony. They move first because their process requires it. They adjust exposure when models change. They diversify when concentration becomes a risk, not a virtue. They hedge when insurance is still cheap. And when insurance gets expensive, it's often because they already arrived. The wealth gap often starts as a timing gap, not because anyone is cheating, because the market rewards those who notice regime shifts early and punishes those who assume yesterday's engine will power tomorrow's road. So no, the rally didn't die on January 28th, 2026. The index made history, but history doesn't always mean strength. Sometimes it means the end of an era. The rally lost its engine, and what's replacing it is a more complicated machine. Broader participation, global rotation, and a persistent bid for protection that refuses to stay quiet. This is the data ledger, where we decode what matters before its headlines. If these dots connected in a new way, you already know what to do. Because the question isn't whether the market changes. The question is whether the engine swap is seen before the ride feels different.